statement.
Yeah, Powell came out and said we're monitoring the virus impact. We're thinking about what tools we would have available to use. It did not have much of an effect, even though people were waiting for something from the Fed. And I think it's because ultimately that statement is exactly what the Fed is expected to do. It would be weird if they weren't monitoring the virus for impact. It would be weird if they weren't thinking about the tools they have at their disposal. Like, that is literally the Fed's job to do that. So although people are expecting more cuts, and some people are hoping, oh, the intermediate cut or 50 basis cut, whatever, they just announced that they're doing their job.
So an email from the Fed saying we're doing our job as we're supposed to do didn't really help the markets at all.
Yeah, not really.
Yeah, and I guess the question, though, is also what's the effectiveness of that job in an environment where the tangible impacts of the coronavirus may not necessarily respond to a rate cut.
Right. And, we could debate whether a rate cut would do anything. It's the Fed's job to boost the economy or to help stabilize the economy. And there's evidence that the economy is probably getting hit by this significantly. So it doesn't make sense for them to do nothing. But, of course, this is a different kind of shock than we've seen post-crisis because it's really sort of so exogenous.
Well, of late, it is the Fed's job, apparently, to support the economy because Jay Powell has said as much.
Absolutely.
To keep the expansion going. All right, let's take a look at the sector performance here today on this 7th day of losses, the 5th day of a week that's been absolutely brutal for anyone who was long U.S. equities. And 24 industry groups, everything is in the red. Let's look at the best performers. Chip makers. Okay, little changed.
Yeah.
Energy, surprisingly, kind of up there, too.
Yeah, energy. I mean, we actually did see some bids come into a lot of these names in both energy and in the tech space. NVIDIA, one of those names actually was doing relatively well today. So, again, some people are looking at some of the larger sell-offs that we've had over the last few weeks and saying, okay, maybe this is a little bit much. Maybe now's the time.
Yeah, energy has bore the brunt of it. These are the worst of climbers.
Yeah.
And a lot of rate-sensitive names, banks, insurance companies.
Yeah. Let's flip up the board. Let's take a look at your lines. This is what I always miss. These are more like squiggles today. But you can see we've kind of been going back and forth. There has been a bit of a tug of war here, Scarlett, because, again, you do see a lot of selling. But then when we sort of reach a few of these technical levels, you do see buyers come back in, at least to start to nibble a little bit and see if maybe there are some safe pockets in equities.
Let me just show you. This is, I'm trying to show you where it would be unchanged, right? This is the zero line. And at one point, the NASDAQ was positive. Right there.
For like a second, and it looked like we were going to get the true turnaround Friday, off the lows, but not by much.
And when did Jay Powell put out his statement?
Well, that was around 2:30.
2:30. So this is what happens.
And we got that bump, and you saw it came back down. But again, you don't have it on the squiggles there. But I mean, you have to also look at what's been happening on the short end of the Treasury curve.
Yes.
And that probably tells you a lot more about market sentiment right now.
All right, 6.5 minutes to go before the close. A close to a very, very long week. And let's check in with our markets reporters to see what they've been monitoring. Ritika, get us started.
Well, I'm looking at cruise stocks, which are getting some respite at the end of the week. Royal Caribbean, Norwegian, cruise lines and Carnival are all higher. Now, shares of these cruise operators have been absolutely battered this week, but they're now bouncing off oversold territory as the 14-day RSI has plunged on these stocks, according to some strategists. And this bounce back comes despite the broader market sell-off. But still, all three are down on the week, more than 20%. In fact, Deutsche Bank downgraded Royal Caribbean and Norwegian to hold overnight, keeping its hold rating on Carnival, saying in a note that realistically they cannot recommend buying these stocks. Abigail?
Well, Ritika, not bouncing off of oversold conditions because they are actually not oversold, which is kind of amazing because if you take a look at these New York stock FANG index, down 13%, Tesla down 27% this week, its worst week ever. We also have Twitter down sharply, Apple down nearly 14%, its worst week since 2008. Again, it's pretty amazing because those are huge losses on the coronavirus fears and what it could do to the global economy. But these stocks are not oversold. That means that there could be more selling pressure ahead. This is a 6-month chart. And we see that just last week when this New York stock FANG index had put in an all-time high, 40% above the 200-day moving average, coming back to earth, but still more than 10% above that moving average. And take a look at the RSI. Those bearish lower highs, certainly a tell on what we're seeing this week, that bearish divergence there. But we still are not even close to oversold. It suggests that there could be more selling, not just for the New York FANG index, Renita, but the broader indexes overall.
Thanks, Abigail. I'm looking at a little bit of an outlier. ExxonMobil clawing into positive territory today. And this is even as oil stocks on a whole and oil prices continue to plunge. But ExxonMobil is also looking ahead to its investor day next week. And energy stocks on a whole are coming off their lows for the day. Yet the S&P 500 Energy Index is still down more than 25% this year. Investors fear that this fast-spreading coronavirus will crush energy demand. Joe?
All right, thank you, Renita, and the rest of the markets team. Now, for more market analysis, we're joined by Bloomberg News cross-asset reporter Katie Greifeld. Katie, just want to know, a little bit of buying here. S&P down 1.6%. That feels like an update at this point.
I know, right? A little bit of dip buying. You can see them nibbling at the edges. But again, it was similar to yesterday. It really felt like we were going to push into the green at one point. We just couldn't get there.
Yeah.
I mean, this is a theme that we've been seeing for the past 6 weeks, that people just don't want to hold risk into the weekend, especially when you have the VIX at 46.
Yeah.
This is a fluid situation. And you've just had a lot of negative headlines today. I mean, not even Powell was able to bump us back into the green with that comment that the Fed is ready to act, especially when you have the WHO, upgrading this to a very high level of risk, and the White House is suggesting that schools could close.
All right, let's bring in right now Federated Hermes Chief Equity Market Strategist, Phil Orlando. Phil, thanks for being here. When you look at sort of how fast, I guess, we fell this week with regards to where we were, I don't know, February 19th when we had that peak on the S&P 500. What does that tell you about market sentiment, and what does it tell you about the potential for a recovery?
So we're down 16% from that all-time record high on February 19th. That is the fastest decline from a record high in the history of civilization. So that it's making a statement, even more than the financial crisis, the bursting of the technology bubble, the meltdown of the housing bubble. So the market is making a statement. And there are two issues that I think are going on right now, both uncertain, that we don't know what the trajectory is of the coronavirus situation, and then the second is the read-through on the economy and the political environment here in the United States. So you've got a tremendous amount of uncertainty, and given the fact that we're sitting at all-time record highs, the easiest course of action is just lock in some profits and wait for some better information.
Are people being forced to do anything right now? Do you see any signs of forced selling, of raising cash, of covering your margins?
No, not at all.
Margin call, sorry.
I think you look at the position that we took, for example, we had a little bit of cash on the sidelines at the beginning of the year, the end of last year. We actually took domestic large cap growth stocks down from overweight to neutral because we thought they were ahead of themselves. We've reversed that over the course of the last couple of days.
Okay.
That stocks have come in. If the broad market's down 16%, a lot of the growth stocks are down 25 and 30%. So we've started to see some value and started to put some of that money back to work.
Katie, your take on the degree to which some of this selling is forced, liquidations, panic, whatever. It's really intense. It's extraordinary. There hasn't been a week like this in years since the crisis. But has it been panicked?
It has felt panicked. I mean, it's hard to argue that it's not when the VIX is just off to the races like that. But in terms of forced selling, I think the only place you've really seen it is in the gold market. I mean, that was a very surprising move, and that's where that margin covering argument came into play. But that's been to the benefit of, obviously treasuries and obviously the yen. I mean, that is just having an outrageous move, up almost 2% against the dollar. That's because people are kind of being forced out of gold right now.
Go ahead, Scarlett.
No, I was going to ask, what kind of phone calls are you getting from clients? I mean, what's their number one question? Is this the bottom?
Well, I had a very interesting conference call this morning with a group of clients from a major bulge bracket firm, and they were very nervous getting onto the call. And an hour later, they said they've calmed down and they have a better feel for what's going on, and they're going to sit tight and sort of watch this play out.
Yeah.
Look at this comeback. The NASDAQ almost flat on the day. Just while we were talking, I guess it must have been people looking at our level-headed discussion of this. NASDAQ on the verge of going green. This is basically...
Well, we should point out, Joe, and the NASDAQ 100 is actually in the green, up about 0.2%. So you strip out all of some of those small companies. So look at that, Joe. You're talking up the markets here. You got the magic, man. All right, but anyway, we should still point out, obviously, still a very bad week for the markets here, a very bad month, really just over the past 7 days. To see the declines that we've had, you get a sense here that people are, for at least once that we've seen in the past few years, really concerned about this market.
You know, with the NASDAQ closing in the green, and if it holds up, you know, we don't know yet because it still has to settle. This would actually be the second advance for the NASDAQ this week, although for the week it is still down 10.5%. So that just gives you a sense of the extent of the damage done here. Volume continues to be much, much higher than what we normally see in the Dow, for instance, 181% above the 20-day average. For the S&P, 139% above the 20-day average.
And I just want to point out, too, on the S&P 500, when we talk about the breadth of this, on a weekly basis, there's only 2 stocks that finished in the green in the S&P 500. Both of those sort of speculative plays surrounding potential coronavirus vaccines, Regeneron, and then the second one is Corvo, which is actually up 2.5% on the week.
One real quick sector other that I'm looking at, energy stocks, small cap energy, up 4.5% today. I mean, this is a sector that just got obliterated thanks to the sort of freezing up of credit markets, no new bond issues in the oil plunge, some serious dip buying there today.
All right, let's check in with our reporters.